Hi everyone, and welcome to this month's webinar, Balance Sheet and Cash Flow Made Easy. My name is Matthew Bowker, and I'm a delivery manager here at Forest Grove Technology. I've been working with Profix for close to a decade. I'm constantly amazed about how much value this product provides. So I'm really happy to be here to talk to you about how it can help with balance sheet and cash flow and making it easier. Today I'm joined by Shak Hamza, who's one of our newest employees here at Forest Grove. He's really great to have on this session. He's a CPA who'd never even seen Profix 6 months ago, so he can really show you how easy it is to pick up and how easy it is to use. We'll be running a Q&A at the end of the webinar, so whilst you're on mute, feel free to make the most of the QA feature. It should be at the bottom of your Zoom window, and you can ask questions on there and we'll try and get to them at the end. If you miss anything in today's webinar, we'll send around an on-demand recording. We've also got a full product demonstration next Thursday, so this is just going to be balance sheet and cash flow made easy. We're going to touch on how to make it easy, and then we're going to touch on how to make it easy with Profix. And so if you want to see a full product demonstration, we're doing another webinar next Thursday. This webinar is the latest in our monthly series that focuses on enhancing agility and adaptability during the changing economic climate. We've already explored how to develop effective scenario models, leverage workflow to assist with collaboration during remote working environments, and how to develop regular, agile rolling forecasts. If you would like to see any of the recordings of our previous webinars, please let us know in the Q&A windows, or there's another chat window as well, and we'll forward you the links. In today's session, we really focused on balance sheet and cash flow. So if this is your first time seeing Profix, as I said, we'll be running a more general overview of Profix in our next webinar. We can also set up a personalized demo if you want to see anything specific or you have any more questions based on today's webinar and you want more detail. Again, please let us know. Today we're going to look at cash flow planning as a kind of overview, the business challenge, how you can set up a roadmap as a solution for your business, and then look at a case study from one of our existing clients. And then Shak's going to show you how easily you can tie this all together with Profix. And then finally we'll conclude with some Q&A. So again, if you've got any questions, type them into the Q&A window. We'll try and get to them as we go along via text, or we'll try and answer them all at the end during the Q&A. So let's get started. Here at Forest Grove, we provide finance and analytics solutions to help businesses make data-driven decisions. We're Australia-wide, and we have offices in Melbourne, Brisbane, and our head office is over here in sunny Perth. We work with a number of leading products, either independently or together, including Profix for finance planning and analysis, NIME Analytics for data extraction, integration, and data science, as well as Microsoft Power BI and Tableau for visualization and dashboard software. If you want any additional information about our services or products, or any of our case studies that we have for some of these clients, please let us know again in the chat window or the Q&A section at the end, and we can talk to you a little bit about it. So an abundance of cash can really be used for investments or to clear debt. The flip side of that is that unexpectedly being out of cash can be pretty devastating and costly. We need to know how much cash we have to plan ahead, manage our current state, and ensure that we're aligning with our business strategy. Living under the cloud of COVID, we really need to be aware of what our cash position is while we operate, but also have the ability to plan dynamically. We have to be ready to adjust our strategy in a very short space of time. Having worked with many organizations over the years, cash flow reporting and cash flow forecasting is something that's always talked about, especially at the start of a project. CFOs in particular are always interested in enhancing their organization's capabilities in this area, and balance sheet and cash flow forecasting really is critical. In Deloitte's recent trends study, 52% of respondents identified manual processes and a lack of automation as the greatest challenge with respect to managing operational finance processes. But why are people spending so long at the end of the month reporting and forecasting and budgeting before that? And the answer is really in this next slide. 72% have identified the main technology they use to prepare budgets and forecasts as spreadsheets. This really shows that taking the process out of Excel and adding them into a tool like Profix is really going to increase your ability to analyze the forecast rather than spend time on manual interventions. I encourage everyone watching this webinar to ask yourself 3 things about their own business. What is our cash position this month? What does our capital structure look like 6, 12, or 18 months from now? And what is the most important metric in our strategic decision making? You should be able to answer these really quickly from wherever you've got your reports and without too much manual intervention. If it changes or if JobKeeper 2.0 comes in, you should be able to add this logic in quickly and redefine all these results. And then we've got a little bonus question here as well. Which of your current reports is the most useful for strategic decision making? And this is one to probably take a second and have a think about. Feel free to let us know in the Q&A window any metrics that you find really useful, and we'll try and address them as we go, or we might address them at the end as well. But if a board looks at your reports and wants some dynamic scenarios, you really need to be able to do this in a meaningful and useful way. And focusing on this metric is really a good starting point. Profix is really such a great tool for answering all these questions, including that last one. It's good for your organization, but implementing a tool like Profix can really define you as a strategic thinker in your business. So it's actually pretty good for your career. Shaq is going to show you how, with the right setup, you can get a current position, a forecast, and dynamic scenario planning with Profix in about 20 minutes. And by the end of this webinar, at a high level, you should be on the right path to drastically reducing your time to insight, with or without using Profix. But let's start from the beginning, and let's lay out a roadmap for where you want to get to. Here at Forest Grove, we've developed this finance transformation roadmap. It's a curve to really map out the steps to getting really good at balance sheet and cash flow reporting and forecasting. And all companies really fall somewhere along this curve. Like anything, balance sheet and forecasting, we're trying to make it easy, but it's not going to happen overnight. It needs to take some time to establish what you want to achieve and then work your way along the curve. So level 0 really starts off with Spreadsheet Anarchy, and most people will recognize this. Data is being pulled out of different systems, it's being pulled into Excel, reconciliation is taking a lot of time, and there's very little time for analysis. So that's level 0. Level 1, this is what we call the minimum standard. Our P&L and our balance sheet are ready as soon as the final journals are closed off. The data reporting is seamless. This can be a problem if your organization has multiple ERPs or different companies that are using different setups. So really building this into a process to take out that manipulation is really should be the first step in your roadmap. And level 2 is where we add cash flow reporting and enhanced distribution. So it takes to level 2 to get cash flow. But again, this should seamlessly work with very little manual intervention. With the balance sheet and the P&L ready, the cash flow should be ready as well. But we really want the reports to be distributed to end users for analysis, reporting, and also the ability to add commentary to why the cash flow is going to happen that way. And then next we add forecasting to the mix. So we're no longer spending time manually getting those reports together. We can spend more time conducting analysis and looking forward. We're forecasting revenue and expenses, and they're feeding into our balance sheet and our cash flow. And at first the finance team do this, but then we really want to start using collaboration. So we're distributing the reports to end users, we're collaborating for inputs, and that's giving us increased accuracy and also increased and better buy-in. We get feedback on the useful metrics and we start adding these to the process. Everyone's starting to get a lot of value from the process now before we enhance it even further in level 5, the top tier or the gold standard. This is where we add dynamic scenario planning, the ability to present a range of options to the business. By following this roadmap, you should be able to answer these questions instantly. Answer those 3 questions we saw earlier instantly. You can then spend your time analyzing those numbers, mapping out scenarios, business cases, and driving your business forward. So talking a little bit about what good cash flow planning is. Organizations with good cash flow planning will require less short-term borrowing or have less excess cash in non-interest bearing bank accounts. Some organizations might be doing this in Excel or at a high level, but if there's a wide disparity between cash flow projections and actual cash flow, it's time to take a look at the process. A lack of information or inaccurate information about the company's cash position will harm the finance chief's credibility. And that will reflect badly on you if you're not the CFO. But as a CFO, if you're unable to answer questions about what's happened to your cash or what's happening to the cash, you really do have a cash flow planning process problem. On this session today, we've got a range of different people. Some are CFOs, some are accountants, but wherever you kind of fall in that finance team, taking ownership of this area is really critical. So there's a few best practices that I just want to kind of touch on quickly here. Using the right tools is, again, really critical. Integrating the data systems, visual dashboards, and offering a snapshot of the company's cash position, as well as a view of the future, is really important. We also want to determine the optimal time range. How often an organization forecasts its cash needs and how far into the future it's going depends on the company, the industry, and the current business climate. If your business has a good number of long-term contracts with predictable payment terms and a high level of vendor compliance, quarterly cash flow planning may be appropriate. But at the moment, with the market as volatile as it is, as we all know, COVID is still around, taking the pulse of the cash flow on a monthly, weekly, or even daily basis at some points is going to be necessary. The next is collaboration. Organizations that succeed in cash flow planning make it an easy collaborative effort. Cash flow forecasting is not something the finance team should be doing alone. Finance team needs to work with business leaders to determine the most volatile expenses and how often they change. And then we really want to try and analyze the level of detail that you need to use in your balance sheet and cash flow planning. The level of detail in your cash flow plan should correlate to the level of flexibility and insight it will provide. For most organizations, a semi-detailed summary level forecast is really sufficient. Let's talk about how to put this into practice though. And UCQ is one of our more recent projects. They've just kind of wrapped up a really large piece of work that included balance sheet and cash flow budgeting. So Uniting Care Queensland is a health and community service provider of the Uniting Care Church, and it supports more than 14,000 people every single day of the year. With over 5 entities, 16,000 staff, and more than 400 geographic locations across Queensland and the Northern Territory, Uniting Care Queensland is one of Australia's largest not-for-profit health and community service providers. But this size and they had 5 legal entities, it really makes planning difficult. Historically, they operated independently with their own management structures, funding arrangements, and business processes, and their own information systems as well. But this was really inefficient. So in 2016, the management processes of each entity were amalgamated with the goal of becoming more efficient in their resource usage, particularly back-end office functions and shared costs. The target was improved reporting, improved forecasting, and the ability to measure success across the same metrics in the whole group. So each UCQ entity used to prepare its own cash flow, and it was governed by its separate rules and assumptions. And it was all done in Excel, which we've seen is really low on our curve. They were spending a lot of time kind of getting that together. Resulting spreadsheets were manually consolidated, it was time consuming, and it was also error prone. So enforcing group-wide assumptions was really problematic. All the different reports were completely different. So what they did first was they integrated their systems with Profix. This allowed them to report on current data, and it really gave them a lot of time saving to focus on the budgeting component and looking forward. The cash flow for selected entities was modeled entirely using Profix, so they could automate that whole budgeting section, the drivers, the calculations that are doing it, make sure they're all on the same page with that and they were doing the same things. They also automated the treasury components as well as the profit and loss and the balance sheet that were feeding into the cash flow. So by doing this, they gained the ability to tightly manage those inputs and also the assumptions and unify the cash flow calculations. A new system allowed the organization to confidently budget its cash position up to 5 years in the future. So this gave them a really scalable solution that they could incorporate additional entities in the system and quickly kind of move up that curve. So they could do easy reporting because they integrated all their systems. They could move into budgeting, which allowed them to move into forecasting and adjusting those scenarios and increase time on scenario modeling and analysis. So we got a poll. It should have popped up on your screen. If you just click on the answer that you have, and I'll give you everyone a second to do that, and then we'll just quickly go through the results. So we've got a few answers coming in. Okay, so yeah, so far and away here of our poll results, Excel at a company level is how most people seem to be doing their cash flow and balance sheet forecasting. So that's, you know, you're not getting a great deal of value out of your cash flow and forecast. Most people that are doing that, I find, tend to be trying to do that to, they're trying to do that to appease their board, really, to give them a board. So it's not becoming a really useful metric for their organization. It's not those end users. We really want to start collaborating with them, distributing the reports to them and letting that kind of cash flow influence their business making decisions as they run their different cost centers, groups or departments. So while cash flow planning tends to get overlooked when capital is plentiful, savvy organizations know that superior cash flow management results in less short-term borrowing and a reduction in excess cash in bank accounts spread throughout their whole geographic footprint, their departments and their cost centers. So again, spreading it out to the business, getting their input and buy-in really helps them to make their decisions and not have so much cash not being used effectively. Spreadsheets and other manual processes for cash flow management do not provide the visibility and accuracy needed to forecast cash to inform strategic business decisions. And organizations that make cash flow management a priority are better positioned to take advantage of changing market conditions that require investments in equipment or other capital-intensive initiatives, as well as optimize the return on their excess cash. So with that as a really kind of an overview of cash flow and how we can make it easier from a kind of process point of view, next Shaq is going to take us through how this might look in Profix and how you can really quickly move up that curve that we saw earlier.
Thanks, Matt. Hi, everyone. Now, typically come period end, most finance teams in organizations prepare the profit and loss statement and balance sheet for review. And these reports are easy enough to get out of the ERP. However, cash flow statements often get neglected due to time constraints and a variety of other reasons. Now, period ends are often really busy times for finance and operations team. They have to confirm the accuracy of results from the previous month. They have to analyze variances, provide explanations and supporting detail for those variances, along with any other additional reporting for operational managers as well as board members. And it's also slightly more complex. The cash flow statement is hard to reproduce quickly at period ends. It involves the calculation of net movements in the balance sheets added back to net profit for the period in question and reclassifying those movements into operating, financing, and investing activities. And it's often a low operational priority. Operational managers are often not required to show a breakdown of cash inflows and outflows for a period. And this, together with other types of reports and analysis demands, sometimes pushes down the priority placed on a cash flow statement. So today what we're going to do is we're going to demonstrate how quickly you can configure a cash flow statement within Profix and then use that configuration along with other features within Profix to create a three-way forecast from the P&L through to the balance sheet and the cash flow statement. So what you should see on your screen now is basically I've logged into Profix. You can see me logged in here as Tony Stark on the right-hand side. This is the web client interface. You can see I've got a dashboard here. So I've got tasks that have been allocated to me from my administrator. I've got a sample of some favorite reports that I've got here. So you can bookmark these like you would bookmark a web page. You've got some metrics here, as well as a chart. And below this, at the bottom of this dashboard, you can see a Power BI embed. And Profix can also help to integrate if you've got presentations or slides or any other type of metrics that you got currently in another system, you can integrate that together with Profix onto the dashboard, like what we've got here with the Power BI tool. So basically what we're going to start off with, when you finish a period end, typically you're going to have your income statement and balance sheet ready to go. So I'm just clicking on an income statement and balance sheet report that we've configured here in Profix. So you can see the income statement here. You've got the logo. You've got your title of the report that you're looking at, the financial period or that it covers, chart of accounts on your left-hand side. Your credits have got brackets and your debits don't. And you can see that we've easily done the income statement and balance sheet. And this is usually the first thing that we look at once your results are finalized. You have a look at your income statement and your subsequent balance sheet, prepare the reconciliations as you go along. Now that's all well and good, but usually the cash flow statements, again, like we mentioned earlier, the one that gets neglected a lot. So what we can do is I've got a link to the full year cash flow statement. So in Profix, you can actually link templates from reports that you design within the environment. So I'm just going to click on this. And you can see that we've got a net profit after tax, adding back your non-cash items, changes to your working capital to arrive at your cash flow from your operating activities, investing activities, and subsequently financing activities. You got your net change in cash and you got your ending cash at bank and the cash at bank. which is the balance sheet account, to make sure that it's zero. So you can just do a quick check there to make sure that there's no variance. And once you've got something like this configured, and I'll just go behind the scenes quickly and just show you how we can actually leverage Profix to help create this, because your income statement and balance sheet are going to be brought into Profix, can be brought into Profix. And once you've got all of those values in there, you can then just make some simple configurations in the back end to just work out the differences between the movements in the balance sheet and adding back the non-cash items on a from your P&L back to your net profit. So I'll just go quickly into Model Manager. So I'll go to Menu and select the Model Manager option. And once we open this up, we can see our chart of accounts here. We've got balance sheet accounts, we've got cash flow accounts, and we've got income statement accounts. We've also got some statistical accounts. So in Profix, you can also have metrics or driver-based accounts created. So it doesn't necessarily only apply to general ledger accounts. Right, so we're gonna open up the cash flow statement just to see how we've gone and worked this out. So we've got our beginning cash for the period and the ending cash of the period. And how we've done it is that we've classified all the different movements from the P&Ls and the P&L and balance sheet accounts into, and then group them according to operating activities, investing activities, or financing activities. And very quickly, we can just work it out because I've set this up as a statistical account. So let's look at payables, for example. And I've gone in, and Profix allows you to custom formulas in, configure formulas in rather. So this function, that lag that we see here, for example, in payables, basically is you're telling Profix to take the value for this account from the previous period, lag 1. So it works like how you would normally have functions within Excel. So again, it's really useful and powerful to have, because once you've configured it once to do one period, whether it's a financial year or a month or a quarter, you can then just run reports for subsequent periods at a click of a button. Like, how powerful is that? You've gone from just P&L and balance sheet that you can typically generate out of the ERP, but when you import all that and put that into Profix, you can actually also configure this to spit out a cash flow statement very quickly, and you've got your P&L, balance sheet, and profit and loss at a click of a button at the end of the month. So again, it's a really, really powerful, but it's such a simple change that can be done once you've got a tool like Profix. And the amount of time you'll save at period ends when you are required to produce a cash flow statement is incredible, because you don't have to worry about the reconciliation issues that would come up if you were doing this manually in spreadsheets. So it's really powerful, really a real time saver. Now, once you've already got a calculation like this configured in Profix, and you're able to spit out cash flow statements like so, what you can do next is now you can leverage these calculations that you've done together with your P&L and balance sheet to come out with a three-way model. And you can forecast your cash flow and balance sheet accounts for a subsequent number of periods. Now we'll go back to our dashboard and we'll click on the three-way forecast for the 2021 financial year. So this is a 1+11, which means we're going to have 1 month of actuals. But instead of having 11 months, I've shortened it to 3 months. We'll click on this just so that it looks a little bit better on the screen. So we've got this in data entry mode. All right, we've got the things that we can change. Now we've got several versions here that we'll go through, and we'll talk through these as we progress through the explanation, through the demonstration. So you can see that we've got your logo here, you've got your name of your model, and you've got the version that we're looking at. And this is the 1+11 forecast or base assumption. And in this case, I've shortened it to 3 months. Now you've got your income statement here. You've got the periods of July, August, September, and October. Now I mentioned before, this is 1+ subsequent periods that are from the budget. So what we've done here is we've got the period of July, which is actuals, and you're not allowed to change, which is important because you don't want your actuals changing. And we've just basically configured Profix to bring across the budgeted amounts for August, September, and October for the P&L and balance sheet, like so. So again, because we've already got the chart of accounts set up for the P&L and the balance sheet and everything else, it's really a question of just pulling these accounts across into a template to design this and configure this. So it doesn't take any time at all. Now, the first assumption that we've got, I'll open this back up, is that our creditor days are now going to be brought to 60 days. So previously they were 90 days. So we paid our creditors we turned over our creditor balances every 90 days, but now you're going to do it in 60 days. And we want to see what impact this has as it flows through from the income statement to the balance sheet and ultimately to your cash flow statement. Now you've noticed that this is a much shorter cash flow statement than what we had previously. And the only reason we're doing that is because we really want to get to the ending cash at bank. That's what we want to know, what our cash balance will be. And I've got a chart here that will change dynamically as we make the changes and make the assumptions. So I'm just going to go into creditors, the first scenario, which is 60 days. So we're reducing our creditors. So you can see our P&L is not going to change. And we'll just have a look at our cash, ending cash at bank, right? Because that will change as we swap through the versions. And you can see that that's all changed and been brought lower. And you can see that this chart is now also exhibiting this. So what we've done here is that we've actually configured in the background changes to your trade payables. So I've highlighted it there. So we've configured the assumption to go, hang on, we're not going to pay it now every 90 days. We're going to turn over our creditors every 60 days. And the moment you swap the versions, the calculations run in the background and automatically spit out a value. Now, the next scenario is that we're going to keep our creditors at 90 days, but we're just going to reduce our gross margin by 30%. So I'm going to click onto that scenario. Now you can see again, our P&L hasn't changed yet because this is what we're going to do now. We've got our actuals and we've got our budget for this period. And now we're going to select this and reduce our gross margin. Okay, we're going to hit refresh and you'll see all these figures change now as the calculations run in the background, and we get a number here at the bottom, and already we see the change as the graph has dynamically processed those changes where we reduce the gross margin and have that flow through our changes in our balance sheet as well as our cash flow statement. Now the third scenario is going to be a combination of both. We're going to reduce gross margin by 30%. And we're going to make sure that our creditor days are now going to be 60 instead of 90. So again, we're going to combine what we did earlier with the two scenarios, but we're going to combine them in the third scenario. So the calculations for the balance sheet will anticipate that instead of doing 90 days, that was the assumption that we had and our base assumption, it's now going to be 60 days. And all we have to do now is just swap over to the third scenario. And again, just reduce this by 30% because the balance sheet is, we configured the balance sheet to calculate that, configure that automatically to be 60 days instead of 90. And I'm just going to bring that down by 30%. Again, hit refresh. And you can see payables have changed as well. And you can see that the cash balance is also now being reflected in the chart below. So this is all happening in real time. So just have a think about this for a moment, because I've just modeled 3 different types of scenarios after creating and after configuring this model, which took no time at all because all these accounts are already existing now in Profix, including our cash flow statement, and the calculations all work. I've already now had a look and gone and seen, hang on quickly, just running by making a few changes, I've seen where my cash balance is going to be at for August, September, and October for the various assumptions and scenarios that we've talked about here. Very, very quickly. Now we can just see that our lowest cash balance is as expected if we just turn over our creditor days within 60 days. And the best scenario that we could hope for is just reducing our gross margin. So we still kept our creditors at 90 days and still turned them over in 90 days. We'd still have the highest possible cash balance, even though our gross margin reduced. And that's probably due to the fact that we're not buying as much inventory because we're not forecasting as many sales. So we're not buying as much stock in, not bringing as much stock in. So obviously, now I'm just going to go and actually pivot this, right? Because I've got the chart of accounts here for the income statement, balance sheet, and cash flow, but I've got time across the page. Now I'm just going to pivot this because I just want to have a look at the data a little bit differently. So I'm going to right click on the template and hit analyze. Right. So this is ad hoc analysis within Profix. Now, if I'm happy with something, or if I want to see something a little bit differently and see how that looks, I can sort of play around with the numbers and the dimensions that I've got already built into this model. Now, what I'll do is I'll just go to pages And I can actually, if you notice that my cursor will actually become a 4-headed arrow, right? And what I'm going to do is, I'm interested in my balance at October, right? And this is good because it does July, August, September, and October. But I just want to see how things would look like over time. For example, instead of over time, I just want to do it over the period of October. So I'm going to click that, drag it across, drop it on October. And straight away, I can see our forecast assumption and our 3 scenarios that we model very quickly side by side, and have a look at all the ending cash at balances. And this is obviously my preferred outcome because it's got the highest cash balance. And you can see that any comment that I made earlier in the model is actually now being stored in Profix, and it now appears even in ad hoc analysis. So you don't lose because changes can be made, and if you've got many people collaborating on your forecast, sometimes if a few people in finance, for example, even just within finance, you'll have a few people just collaborating on a forecast. You can actually make so many changes, you might lose track of them. But obviously Profix has now saved this, and I can just pivot the dimensions over, but the cell in which the comment was saved is going to remain, and it's just going to stay, with the data, regardless wherever it goes. And data history in Profix allows you to keep track of all the changes and whoever made these changes. And you can see that it was done by myself, Tony Stark, and that's recorded as well. So again, you've got data history. So if you're collaborating, it's the perfect tool to collaborate with finance and operations teams, because everybody's changes are going to be tracked. They just need to be registered users within Profix. So it's really powerful. And quickly, how we've done this in like 15 minutes practically. And we've going from a forecast assumption, we've configured our cash flow statement, and we've pushed that on to doing a 3-way. And you can see that the balances in the report all check out with the balance sheet number. So the cash flow the ending cash at bank for cash flow ties in together with our balance sheet account. And that's really, really powerful. The fact that you don't have to spend time going through and figuring out, oh, what have I missed? Because Excel is great. Because when I was in commerce before as a management accountant, I was always looking at if things didn't reconcile, it was a nightmare. It was either a 5-minute job or a 15-minute job or a 50-minute job, depending on how long it takes to identify where the variance, what was causing the variance. So it's really a really handy tool, and it was something I wish that I definitely had when I was in commerce. So let me just go back to our slideshow. So what we've shown here is practically the configuration of the cash flow statement, and we've leveraged the tools within Profix to build a 3-way model. So you can see how quickly we've done this, and the amount of time you could potentially save at period ends when time is at a premium is amazing, because now you're not spending time doing reconciliations. What you're actually doing is actually looking at the data and going, okay, these are the scenarios that I think will eventuate. Let's spend time now on thinking of what actions do we need to take should these scenarios eventuate in the next 3 months. So it's a really powerful time-saving tool. And you can see that from the finance transformation roadmap, we've gone quickly from Spreadsheet Anarchy, which we would have in multiple Excel spreadsheets, all the way up to dynamic scenario planning. Over to you, Matt.
Thanks, Shaq. That was really great. I really think that showed how easy it was. Putting in those calculations, there's no coding required. That's all really basic, and there's no kind of errors, hashtag error issues that you're pretty familiar with in Excel. So we really took it from just getting those reports out to really doing those dynamic scenario planning. And obviously we're just scratching the surface with this. So if you want more detail, please let us know. There's definitely other things we can do. This is just a very high level, trying to make it a little bit easy about how Profix works. So we've got some time now just for 1 or 2 quick questions. There's a Q&A box at the bottom. If you click on the Q&A box, you should be able to type in any questions. We've got one question that came through during the session, and that says, how long will this take in Profix? And unfortunately for us, it's a bit of a difficult question to kind of conceptualize. It's very dependent on the company, depending on how complicated it is, and it depends where you're at on this curve. So if you, if you want to just do it at a high level to start with, it's going to be pretty quick. What we've built here is just a very quick, easy one, but you probably want to then spend a bit more time making it more useful. getting collaboration, getting that input from other business users. So do we have any other questions to type in the box? If anyone has any questions, please type it in the box as we say. There's another one coming in that says, how do we create debt to equity ratios in Profix? I don't know that we can really demonstrate it now, but maybe Shaq, if you could just give us a quick overview of how that works.
Sure. So we had a look at our income statement and balance sheet accounts. So your debt to equity will be in your balance sheet accounts. So all you really need to do is actually just pull the accounts over in a formula. So you create a statistical account. As we saw earlier in the model manager, you create a statistical account and go debt to equity, and you bring over your debt accounts, bracket them like how you would in typing a formula in Excel, just doing the slash and putting the entire equity line, because you've got a hierarchy and all your accounts will fit into equity. You can just drag in that formula, and there you go. That's your debt to equity ratio.
Fantastic. Okay, well, I think that's all the time we've got. As we said, if you have any other questions, please let us know. Please let us know after this section or type it in. So the next, says virtual training there, but the next webinar that we have next week is really a overview of Profix, and it goes into a lot more detail as to kind of what Profix is, and we've only really scratched the surface today on how you could use Profix for cash flow and balance sheet to make it easier. But if you want more detail about the other things Profix does, how we maybe got some of those figures in for the P&L and the balance sheet to begin with, I encourage you to register for the next Profix overview webinar next Thursday. If you click on the chat box at the bottom, I've actually put a registration link in there now. So you can go ahead and register for that straight away. And that should really give you a more rounded overview with a lot more detail as to Profix and the overview of Profix as a tool. So thanks for attending today, everyone. Sorry. Thanks for attending, everyone, today. If you have any other questions, as I say, please let us know. My email address is at the bottom, but other than that, we'll see you at the next webinar. Thanks.